So I'm Jason Bordainick. I'm co-founder and managing partner of Hudson Valley Property Group. So this presentation won't be for everyone. What it'll be for is those investors who are looking for a strategy that gets consistent and reliable returns in all markets, inflation protection, tax efficiency, and a strategy that gets both great returns as well as impact. And so, yeah, you might be thinking that's too good to be true, but I'm going to go through who we are and how we do that and leave some time at the end for some questions. And so, yeah, and so my firm, Hudson Valley Property Group, is exclusively focused on the acquisition and preservation of affordable housing. We were founded in 2010, so we've been around for going on 14 years now and have built a best-in-class platform in our space. Over those 14 years, we've acquired more than 10,000 units, done more than $2 billion, $2.5 billion of transactions, and really honed our strategy and approach to do the preservation of affordable housing better than any firm out there. And from a high level, what is our strategy? Our strategy is, you look at the need for affordable housing, there is a huge demand for it and a dwindling supply. So there's a huge supply-demand imbalance that's only getting worse. And then when you look at the supply that's out there, it's a highly fragmented and unprofessional space. And so from a big picture, what it is that we do is we're professionalizing the affordable housing asset class at scale. And in doing so, we take a mismanaged space, we provide efficiencies and proper management. And in doing so, we're generating great returns for investors and improving on the quality of housing for our residents. So in this presentation, I'm going to go through that in more detail. So that's our strategy. We have a value-added approach. We're vertically integrated. So when people who invest with us, they're not investing into an allocator who is then looking for operating partners. We have a built-out platform that enables us to offer investors direct access to the opportunities. We have the know-how and the expertise to execute, to finance, to asset manage, and to oversee the projects that are adding value to investors. When we look at it, people ask, when they look at what our track record is, they see a pretty phenomenal track record in delivering returns. But what's unique about this, it's one that is, because there's a lot of value add and there's a lot of inefficiencies, we're able to deliver that value, but we're also doing so with low risk. I mean, our average property that we own and operate has a multi-year waiting list of residents looking to live there. So there's a very reliable revenue stream that's associated with it. But because of all the various value adds, which I'm going to go through, we're able to really deliver outsized returns for the level of risk that we're offering. And then beyond the financial benefits, we also have a built-out ESG framework. Last year we got recognition as the ESG Fund of the Year by Private Equity Wire. We have a really thoughtful, ESG framework that's tied to various UN goals, including the sustainability of the infrastructure, as well as ensuring access for safe and adequate affordable housing and basic services for our communities around the country. And so as I mentioned, we've been around for going on 14 years now. We started out raising capital on a deal-by-deal basis, building our track record. Then we launched our first institutional fund. Been outperforming on the first fund. The second fund was launched a few years ago. That fund is now going to be fully deployed by the end of the year, and we are about to be in the market for our third institutional fund with a target raise of $600 million. And so that's kind of looking at it from a strategy and kind of high level of what the asset class is, how we play within it. But just taking some of the basic questions, because this might be the first time people here in person and over Zoom are hearing about affordable housing. What is affordable housing? So when we define affordable housing, we are talking about housing that's targeted towards low and moderate income individuals and families. A large segment of that are retired individuals that may have been in higher income bands, but now are on a fixed income. So that's who we target. So there's a component of who we target, but then the other layer of it is the housing is one, targeted to those income bands, but two, is set up where those individuals and families pay no more than 30% of their income. Now, people may say, well, that number may not be so great. How are you generating the revenues? So that is the portion that they're paying out of pocket. A very large percentage of the affordable housing that we focus on are on government programs where the resident pays their 30% of their income. However, as owner of the property, we receive a market level of rent. So the 30% is not the total revenue received at the properties, it's just the portion that the resident pays. We have a question. So the question was, is that considered Section 8? So Section 8 is actually the third thing on here is actually the no. So Section 8 would be the largest program under HUD, the federal agency that administers it, to enable individuals. So yes, to enable individuals to pay 30% of their income. So Section 8 would be the largest federal program. Another large program out there is the Low Income Housing Tax Credit Program. And that is a program that was set up to subsidize. So the Section 8 program subsidized the rents that are paid by the residents. And then the other major program, the LIHTC program, subsidizes the development costs of the property to enable the rents to be at a lower point. But those two programs are the largest public programs that service affordable housing. And so when we talk about affordable housing in our strategy, we say capital A affordable, because there's capital A and there's lowercase a affordable, meaning we focus on properties that are on some sort of regulated program like Section 8 or LIHTC versus something that is affordable by nature, which just happens to service those bands. And there's complexities, there's compliance, there's a lot of expertise needed in order to operate in the capital affordable space, and that becomes a barrier to entry. It also becomes a lot of where we add value. We have great relationships with those agencies, and we know the various tools that are being created and how to best optimize them and leverage the public programs with private investment. And so, so those are kind of the subset of affordable housing that we focus on. And when people say who lives in affordable housing, so when you're in cities and various urban markets where we focus, these are your average workforce, people who are teachers, police officers, civil servants, and the people who are working in the stores, the cashiers. It's entry level jobs and also jobs that are the kind of key functioning jobs to make sure we have basic services, healthcare services, educational services in our communities, and they're critical in each of the areas. And so governments are constantly trying to figure out how to best serve this. And our model is a very efficient way because we basically take what's there and make it nicer and leverage the programs with private investment. And, moving on from here's going through the business case, the Section 8 and the LIHTC programs, those are about 4 million units. That's all the way here on the left. And so that's the supply that we target. And the demand for that, based on various estimates, is nearly 4 times, 5 times that supply. This chart is intended to show not only is that supply, so that supply is where we focus, but they're on programs that expire. Every one of the programs has, whether it's 20, 30, 40 years of term when they're put on. And this shows basically over the next, several, different year bands, how many units that we're in danger of losing. And so where policy has moved is to say, how do we preserve this supply, because it's so expensive, way more expensive to build new than it is to preserve what's already there and already built and where people are living. So, again, going through the business case, you have, low supply, high demand, which we've hit on a few different times. That ensures, that you're going to have a very high occupancy and also, a safe stream of revenues. The second is it's a very fragmented, non-institutional on the ownership side, on the asset class, as well as an aging ownership base. So you have a lot of owners who have been involved with the real estate. The next generation may not be also involved, and there's a lot of legacy owners who are going to be looking to exit from the space, and so there's good trends on that side as well.
Jason, these are mostly private owners. They're not REITs.
Yeah, so because these are very, very high percentage of mom and pop ownership, family offices. REITs are only more recently getting involved in the space, and so this is, from a look at it from a opportunity standpoint, it's moving from a mom and pop, unsophisticated, non-institutional ownership base to a more institutional, and that's where the value is going to be created, and that's where we're going. We're going to, from a business plan standpoint, is as we continue to build scale, exiting to the lower cost of capital that would come with like REITs and these other institutional owners will be help generate the returns for our investors. So we're really consolidating the space. And, I think we hit on from an occupancy, and then the last is, a common question people are saying, hey, we have an election year. What happens if this person gets into office or this person gets into office? The good thing about our strategy is that it has bipartisan support. We don't deal with the NIMBYism, not in my backyard, because these are properties that exist in communities. And what we are doing is we are making them nicer. We don't get political opposition. We also are spurring private investment into communities. We're creating jobs. So regardless of what side of the aisle you're on, there is support for the preservation programs and tools. And so it's something that not only does it work in various economic environments, it also works in different political environments.
So your strategy is more of a value add strategy. You're not repositioning these things. They're just they already exist. You're not building new ones.
Nope. No. This is really existing multifamily that are on an affordable program today, typically 200 plus units, and typically, owned by an operator who does not have the scale and the sophistication to operate it optimally. And we bring the scale and the expertise to operate it efficiently. We utilize the various tools, which include incentives for making improvements, getting rent increases from the government, getting tax incentives on the properties from local municipalities, leveraging, investments to bring energy efficiencies and to bring, our relationships at scale to operate the properties better. And so that's kind of, it's a value add approach.
Are the
And
properties mostly in the Northeast or where are they?
yeah, so we're based in New York City, and we now operate in 11 states, with our highest concentration in the Northeast. Over time, that'll get more diversified as we continue to expand, but it's typically high cost of living, urban markets, not just tier 1, tier 2, tier 3. And there's a higher concentration of those types of markets in the Northeast than there are in other regions, but we are going to be on the West Coast and Texas and Southeast as well.
And just as an aside, public housing is on the decline, right? I mean, there used to be public housing in Connecticut, but a lot of it got converted into this sort of real estate.
Yeah, so we, what we focus on are privately owned housing, and they're not public housing, but a lot of the publicly funded housing, publicly owned housing, they're aging, they're blighted, they're in need of deferred maintenance, a lot of investment, and a lot of the municipalities and areas have budgets that are getting cut, and so there is a bigger, like an overarching trend of the private markets playing a bigger and bigger role. And so, yeah, it's another kind of tailwind that we're seeing in our business. And then this next one is kind of looking at it, we talk about, I said, one of the points I made was that it works well in all different markets. This shows really, because sometimes people say, oh, you're serving a lower income band, you must have poor collections. It's actually the opposite. Because these are, the housing is set up where the residents pay no more than 30% of their income, and because it's such a really good deal for them compared to alternatives in the market, there's a natural protection because they know that if they lose this housing, their alternatives are much worse. And we have a wait list to go into each one of their units. During COVID, during the downturn, we've had 98, 99% collections. This chart shows, even going further back industry wide, that it actually has had a higher collections than market rate housing.
You weren't subject to any of the rent relief programs or things like that?
Rent relief. So there was various programs created during COVID that helped residents to pay their 30% portion, and that was a benefit. And we actually saw even higher than 98, 99% collections during some periods of time. So those programs did benefit our residents, and we made sure to communicate that to the residents to say, hey, making sure you're aware there's these programs available. Everyone here should be filling it out if you need this. And so, yeah, that was something that did benefit. I mean, it wasn't solely restricted to low income. It was really anyone who was impacted, but we made sure that our residents knew about the availability to take advantage. So yeah, I'll hit on some of these things. These are typically, I said here, 150 units or more, typically 200 units or more, and then increasingly are more portfolios, people exiting. You have a question? Yeah, so the question is about where are the returns coming from? So we are, and this is not a buy and flip strategy, it's a buy and hold. So we are getting we are generating high cash on cash yields through improving the NOI of the properties. So before we close on the properties, we're typically renegotiating these rental contracts with the government, for the improvements that we're going to make, negotiating, better property tax treatments to lower that burden, negotiating the various contracts on, repair maintenance and various supply contracts. We're going in pre-closing and really adding a ton of value to, reduce the OpEx, increase the revenues, so that when we get in there, we get to a 10% cash on cash yield, during the hold, and then the additional return comes from residual, which could be refinances, which could be recapitalizing, or could be a sale. But the bigger vision of where we're going with our strategy is, our first fund, we bought about $1 billion of real estate. Our second fund, we're going to buy between 2 and 3 billion of real estate. And then this latest fund, this fund that we're giving, you guys are getting an early preview of, that we're launching now, is going to end up, probably buying 3 to 4 billion of real estate between investment, debt, even and co-investment. We're going to have a very large and stabilized portfolio that's going to have after I finish the thought, I'll get the question. That, creating the scale will make it investable by more investors who are interested in the space today. Like, large institutions are very interested in the space because of the reasons I gave, but it's because it's so fragmented. They're like, oh, we can't invest this money. Like in a pension, we get calls from places like that often, and they want to invest 150, 200, $500 million in the space, but they really need someone who's going to aggregate it and build the scale. And that's a role that we're playing, and it will create options for either recapitalizing it through that or selling it to an institutional base. For the question, yeah.
Last question is, don't really know the structure of fund. Is it permanent capital, or is it?
Okay. Yeah. So our funds have been close-ended, 10-year private equity funds, pretty standard private equity type structures. Ultimately, there will be options to recapitalize our funds into a permanent vehicle, but our third fund will be a close-ended private equity fund structure. We have typically set up various other structures for tax efficiencies, and we're very sophisticated on that front to meet the demands of whether it's an endowment, foundation, international investor, or family office, but it's into a close-ended private equity fund. There's an ability with investor approval to go out to 13 years with 3 one-year extensions typically in our funds. But it's a close-ended strategy. And your question on debt, yeah, we view that as one of the value adds, is that there are between the GSEs, the Fannie, the Freddie, Fannie Mae, Freddie Mac, and FHA, which is a government supported financing program. They have below market interest rate financing products with better terms, better underwriting parameters that are available to our asset class, and we're able to leverage that as one of our value adds as well. We're one of the top 3 Fannie Mae affordable borrowers in the country. We're very, we're able to get better pricing on financing, and we also have investors who will purchase direct private placements, and so the financing side is definitely a value add to when you're buying from sort of smaller mom and pop sellers who may not have access to the same rates and financing products, and also things that are not available in other asset classes.
You've got, by the way, there's about 5 minutes left.
Okay.
In the presentation, so.
Yeah. I'll go. Let me just kind of go. Yeah. So I'll hit on. I'll kind of go a little bit faster on the last few slides. Obviously, anyone looking to connect afterwards, happy to talk further for things that aren't addressed. But yeah, we have a very thoughtful value add frame. We go through checklists and thinking of all the different ways. We won't take on a project unless there's multiple ways of adding value, whether it's optimizing the revenue, expense, minimizing the tax. There, from the development side, sometimes there's FAR or air rights that could be sold off or help to provide additional value to investors. We're very hands-on with asset management. We incorporate a lot of technology with getting good data real time to make decisions, and use that as one of our advantages. And this gives you an example. These are just from one of our this looks like this is our first fund. we will go through and the check marks are all the different value adds. We won't take on a project if there's not multiple value adds, and that's how we kind of get to, some of our returns. We have a very thoughtful process. This is for our second portfolio. Very similarly, we have a very, consistent, being very disciplined to only take on projects that we could add value in a variety of ways. And then
So right now you have 5,000 doors, or you've got 9,000 doors?
we have 10,000 in our portfolio, and we are expecting to be at close to double that by next year based on our pipeline.
So we've had a lot of people in this space present to our group over the past, but as you said, most of them are aging out, right? And a lot of them stop building, affordable housing or workforce housing. They all move to luxury. So it seems like there's a great opportunity. What is there leverage from the government when you do these strategies, or is it primarily you have to get the leverage from the banks or private lenders or?
Well, we have a seat at the table in these conversations I'm on various policy committees. And so a lot of these public tools are coming out to incentivize groups like us to have strategies around investing into these properties. And so we're able to layer in additional financing or to get additional support. And then, in the final slides, which we won't have time to go through, our Fund 1, Fund 2, we were targeting for investors net 15% returns, three times multiple is what we were targeting for them, and our track record has been meaningfully better than that. And that's because of, again, barriers to entry, the fact that we built out a really best-in-class platform to do this, and very few groups who have the combination of the operating know-how and the capital. And so, so as we continue to grow, we see bigger opportunities as we build out our platform, build out our capital base to do it in other markets and do it at more scale. And so I think I'm coming up on time. I think there's a final slide I was just going to get to. And so, people are like, well, this sounds fantastic, affordable housing, but why you guys? And we really have the best in class team. Our people, we have an amazing team, varied backgrounds, and we are vertically integrated and different from other groups. This is all we do. So sometimes there are some name groups in our space where it's one arm of their business, one strategy under their platform, and they do market rate, they do affordable, they do ground up development. But what's really differentiated us is that from top to bottom, we have thoughtfully put together the right team, the right systems, the right process to do this, better than any other group, because this is all we do. And that reputation is out in the marketplace. So when there's big opportunities, they're like, okay, Hudson Valley Property Group is going to be one of the groups that we talk to. And right now, there's, as Marty was saying, I think this space is getting more institutionalized. There's more interest. Some of the big name groups are starting to kind of look at it. And what that's creating is more advisors who are shaking loose more opportunities. And we have a robust pipeline, and happy to be able to present here and connect with others who are interested in learning more.
Great job, Jason. Thanks so much. I have some comments on the slideshow. We'll talk about it afterwards, but first, it's fantastic. But I would love to get more data on who are the bigger owners who are aging out. Rich Richmond, he's presented our group many times. I think he owns 150,000 units, right? But I don't think his next generation is doing anything. So
no, and I know Rich. I actually saw him at an event last week, and he's a big tax credit investor, so typically on the LP side. But that's an example of, we're not really competing against the Richmond Group. From the private equity investment side, we're one of a few number of groups that have that type of capital for these types of opportunities.
Sure, yeah. I'm saying, we'll have a phone call afterwards and talk about a couple ways, like 2 slides to spice it up a little bit. I thought it's great, by the way.
All right,
You know,
thank you.
we know the segment and that, you know, and actually we like it a lot. So our group likes it. So
Awesome.